In today's recording, we're going to go over some examples of account types and make sure you know their normal balance and which financial statement they go on. And then also we're going to do some examples for your homework. Before you watch this video, you need to watch the debit and credit how-to video that should have already shown you some initial examples of journal entries and debits and credits. So this is really just a practice screen. I will post a blank one of these you could print out and practice. My idea for this would be that you would run through this on your own and make sure that you can label everything with their account type. So these are your account types here that I've listed. So you might want to indicate for supplies, since it's an asset, you would say that's an A for asset. So that's the account type. Since assets are on the balance sheet, you would say, well, supplies will show up on the balance sheet, and you'd say BS for that. And because supplies are an asset, which is right here, on the left side of the accounting equation, the left side are the debits, and the right side are the credits. Debits on the left, credits on the right. Your assets are normally a debit. So you would say your supplies would hold a normal debit balance. Well, let's look at interest income. So interest income is a revenue account. So you give it an R. Revenue shows up on the income statement. So you would say income statement. And it has a normal balance of a credit because it's on the right side of the accounting equation. So work through these. I'll post the answers, but you need to be able to identify the type. So here's your type, your financial statement, and the normal balance of each of these accounts. If you can't quickly identify these, then it's going to be really hard going forward to do journal entries. So you need to get really good at identifying what type of account, which financial statement, and the normal balance. So work through those, and I'll post the answers. So I wanted to start off and just do a long example of journal entries, and then I'll do a problem that's a lot like one of your homeworks. So here is a company who's got transactions for March, and these are in your book. I believe this is problem number 10, or exercise number 10, I think, in the back of your chapter. So let's just start with March. So in March, we paid rent for the month. So we're going to pay cash out. So cash is usually a good place to start. What did we do with cash? Well, because we paid for something, cash went down. Since cash is normally a debit because it's an asset, to make it go down, you're going to credit cash. So I'm going to put cash as a credit for that $2,500. The DR stands for debit. The CR stands for credit. The debit's on the left and the credit's on the right. And because cash is normally an asset and it has a debit balance, we make it go down with the opposite of its normal balance, which is a credit. So we're going to describe what we paid for with an expense account. We're going to call it rent expense. Expenses are normally debits, and they usually describe what we pay for. Okay, so that's the number one. On March 3rd, we paid for advertising expenses. So again, our cash is going to go down because we paid for something. So let's credit cash. Cash is going down for $675. We're going to describe with our debit what we paid for. Advertising expense. Now, advertising expense, just like all expenses, are normally debits. So we are increasing our expense, so it's a debit. You got to make sure that you're always in balance on both sides of your journal entry. So if you credit something for $675, you're also going to have to debit for a total of $675. Okay, March 5th, we paid, again, cash for supplies. So cash will be our credit because cash is being paid. and we're going to describe what we paid for with supplies. Now, supplies are unique. We're not going to put them in supplies expense because supplies is almost like buying a bunch of inventory and putting it on a shelf, and we don't get to expense it until we use it. So we're going to put everything on the shelf. When we pay for all the supplies, I want you to put them on this shelf, which we just call the plain old supplies account. And this is an asset account. So it's going to hang out there until we use it, and then we'll expense it. March 6th, we purchased office equipment on account. So this on account here is our indicator that we did not pay cash for this. So we paid for it with something else other than cash, and our only other thing that we've been paying for stuff with is, so far, is accounts payable. So we're going to credit accounts payable. Accounts payable is a liability account, normally a credit. So we're increasing our liability account by crediting it. And we're going to describe what we bought with our debit, which is office equipment. Office equipment is an asset, so we're going to debit it. Okay, March 10th. We received cash from customers on account. So on account means that when we originally billed the customer, we would have increased our accounts receivable. And it probably would have looked something like this. Accounts receivable is our debit, and maybe fees earned or professional fees or some kind of revenue account would be our credit. Well, what happened on the 10th is now this has been paid for, so we need to remove it. So our accounts receivable is sitting on our balance sheet in a debit balance of $16,550. And if our customer pays us, we need to take it off the books. So we're going to remove our accounts receivable by crediting accounts receivable. So now accounts receivable is 0. And because we received cash and cash went up, that's going to be our debit. Okay, on the 15th, we paid a creditor on account. So again, originally it probably would have looked something like this. Whatever expense would have been the debit for $31.80 when we bought it, and we would have credited accounts payable so we could pay later. But now we're paying it, so we're actually going to use cash and pay that off. So to make this become 0, we need to debit that account. It's sitting over there normally as a credit. To make it 0, we need to debit it. So that's the first thing we're going to do on the 15th is accounts payable for $31.80. Now it's 0. Now accounts payable is going to be 0 because we have paid this off. And cash, we used cash to pay for it, so cash is going to go down. And when cash goes down, that's a credit. Right, on March 27th, we paid cash for repairs to office equipment. So we're paying for some cash with cash. So our cash is going to go down. And we're going to describe what we use that cash for with our debit. So I'm going to say repairs expense. Making sure to maintain balance all the way down. Okay. Then on the 30th, we are going to pay for a telephone bill. Again, we're going to use cash, so cash goes down with a credit. We could call it phone expense or utility expense. To describe it. On the 31st, we have fees earned and then billed to customers for the month. So this is services we've provided, but we didn't get paid yet. We're just going to send a bill, but we want to show that we've earned that $49,770. So if we want to record some revenue, fees earned is a revenue account, which is normally a credit, so that's going to be our credit. and we're going to say we're going to get paid later. We didn't receive the cash. If we had gotten paid, we would debit cash and cash would go up. But we don't get the cash yet, so we need a holding place until we get the cash. So we're going to debit accounts receivable, which is an asset. On the 31st, we paid an electricity bill. So paid is an indicator that we use cash here. So you can credit cash for the amount we paid. Cash went down. And then utilities expense is our debit. And finally, our owner withdrew cash from the company for personal use, $17.50. So as you know, cash is leaving the company, so going out of the company pocket and into the personal owner's pocket. So cash in the company went down. We're going to use a credit to cash to indicate cash went down. And we're going to describe what happened by taking it out of Cammie's capital account, and we're going to call it a withdrawal. So withdrawals are normally debits, and so we will debit the drawing account for $17.50. Okay, so that's just more examples of journal entries and how you might see them here listed in quizzes and on a test, and then you'll need to understand how to do the journal entry that goes with it, and making sure that you balance on the left and the right side of your journal entry. Okay, so moving on, I'm going to do this other longer example. I'm going to do problem 21A, and in your homework you need to do 21B. So 21B is very similar. And the whole point of this is you're given some transactions here, listed here A through N, and you're supposed to put them in a T account. So I've got some T accounts here. And then after we have all of our accounts posted, or our transactions posted in T accounts, we're going to put all the balances into a trial balance. Okay? So talk about that in a minute. So starting with, we're not going to do journal entries, although you would do the journal entry, and then after you do the journal entry, you'd actually post it to a T account. We're using the T accounts to keep track of the balance in our accounts. So starting with A, we transferred cash from a personal bank account to an account to be used for business, and that was $18,000. So our cash went up into the company, and our capital for Kim, our owner, is our credit. Okay? Again, so that I can stay on this screen, it would be helpful if you turn to problem 21A in your book, or of course you can flip up to the top of the screen and you can see the problems. I'll just be reading them to you. So that's A, we'll say. A. Okay, B, we paid some rent for office and workroom. So cash went down, so we're going to credit our cash this time for $19.50, and we're going to debit our rent expense, which is to describe, so it's down here, rent expense would be our debit to describe what we did with that money. C, we purchased an automobile for $28,500. $5,700 of it was with cash, and the rest was with a note. So the debit part of that, C, is that we bought an asset we're going to call auto. So that's our asset. When assets increase, we debit those. And then we use some cash, so cash went down. And then we also have a note for the remaining balance. So we have $5,700, C, needs to come out of cash, and then the rest, which should be $22,800, is going to be a note payable, which is here. So notice our two credits equal our one debit. So you have to be in balance on both sides of the entry. Okay, D, we purchased office and computer equipment on account. So that means we did not pay cash. So the first thing that we need to do is debit our equipment. So that would be our asset for $4,500. And on account means we used accounts payable and not cash. So we're not going to credit cash. Cash didn't go down yet. We didn't use it yet. So use account payable. E, we paid cash for supplies. So cash did go down, $1,875. And we use that to buy these supplies. So if you've got a debit and a credit that equal the same amount, make sure not to add credits if you're not going to add the same amount of debits. You have to stay equal on both sides. F, paid cash for annual insurance policy. So since we're paying for insurance all up front, we're going to call this, and we haven't used any of it yet, we're going to call this prepaid insurance for $3,600. And then we'll get to expense our insurance as insurance expense when we use it. So we haven't used it yet. When we pay premiums on an insurance policy, it's going to be an asset called prepaid insurance. And the credit is going to go to cash because we paid this premium with cash. $3,600. G, received cash from client for plans delivered. So it sounds like we provided some services, which your book calls professional fees. You could also call this fees earned. It's a revenue account, and we're just going to call it professional fees. So this is G. Revenues are normally credits, so we are increasing our revenue by crediting it. And we received the cash, so we're going to add some cash up here for $13,650 is going to go in our bank account. H, we paid cash for miscellaneous expenses, so our cash went down $2,600. And we can describe that with just a miscellaneous expense title, debiting miscellaneous expense. I, we paid cash to creditors on account. So this is a situation where we already had an accounts payable that we owed. So it was sitting over here in accounts payable as a credit and we owed it. So when we pay it, we need to remove the accounts payable. Since accounts payable is normally a credit, to make it go down, we have to debit it. So we're going to debit accounts payable for $3,000. Now it's going to go down. And we use some cash to do this, so our cash goes down with our credit. We paid installment due on note payable, so we made a payment on a note. So if we made a payment, we use some cash. Cash goes down, so we're going to credit cash when it goes down. And then also because we paid some of this note, our note went down. So since our note is a liability and normally a credit, if we want it to go down, we need to debit it. So debit notes payable is J. K, we received an invoice for blueprint service. It's due in February. So we used some services, blueprints, but we didn't pay for it yet, so we owe it. So we're going to, this is K, we're going to credit accounts payable for the amount we owe, $37.50, and we're going to call it blueprint expense, $37.50. Right? We recorded fees earned on plans delivered and payment to be received, $21,900. So again, we sent some bills for some services for professional fees. This is L, but we didn't get paid yet. So we're going to put that in accounts receivable, which is up here. We didn't get paid. We just sent the bills. So they still owe us. So we're going to get credit for the fees earned, or professional fees, which is revenue, but we didn't get the cash yet, so we're going to put it in a holding place called accounts receivable until we get the cash. And we paid salary for our assistants, and I've got salary expense here for M, 4,100, and we paid cash for M, so cash is going down with a credit. And lastly, we paid gas, oil, and repairs on our automobile. So cash is going to go down. I'm kind of running out of room. And cash is going down with a credit. And I believe we're calling this auto expense. So N, auto expense. Okay, so we've got all of our debits and credits, and if you kept every time you made a transaction, you made sure you had a debit that equaled the same amount of your credit. Now you can total everything up and prepare a trial balance. So all of our, I'm going to just highlight the totals. So if you add all your debits for cash and subtract all your credits for cash, you should have a balance, and try this in your calculator, of $6,575. So that's a cash balance. We only had one entry for equipment, so that's the balance. If you only have one entry, so some of these only have one entry, that's our balance. And for the rest that don't have a balance, we need to total them up. So you add the left side, you subtract the right side, and this notes payable balance should be a credit of $21,850. If you end up with a negative in your calculator, it's going to be a credit balance. And then accounts payable, add the $3,000, subtract the $450 and the $37.50, should be a credit balance of $52.50. And finally, professional fees are both credits, so it's going to be a credit balance if you add them up, $35,550. Okay, so everything now has a balance, all our T accounts. So now we're going to take all our balances, keeping them on if they're on the left or the right, and put them in a trial balance. So let's start with cash. Cash is cash and accounts receivable. So cash is $6,575. $6,575. Accounts receivable. Debit balance $21,900. So make sure, because it's a debit balance, we're going to put it on the debit side. Supplies, debit balance $1,875. Prepaid insurance, debit balance $3,600. Auto, debit balance of $28,500. Equipment, debit balance of $4,500. Note payable. This is a credit balance of $21,850. So you put $21,850 on the credit side. So now we're making sure that's on the right side. Accounts payable, credit balance $52.50. Kim Capital, credit balance $18,000. Professional fees, credit balance of $35,550. Salary expense, there you are, debit balance $4,100. Blueprint expense, debit balance $37.50. Rent expense, debit balance $19.50. auto expense, debit balance, 1,300, and miscellaneous expense, 2,600 on the debit side. Okay, so at this point where you've got all of your balances, and you've got them on either the left or the right, depending on how they worked out, now you're going to add them all up. So you add all your debits together, and you add all your credits together. And if you made sure that you had the same amount on that when you debited an account on the left, that you also credited another account for the same amount, then these amounts should be the same on each side. So you should be able to add up all your debits and all your credits, and they should total to the same amount. So mine are 80,650, 80,650. So if you get to this point and you don't balance, that's good. That's just telling you something's on the wrong side, or you missed one. And so then go back and make sure to add them up. So you've got one very similar to this. You're going to need to do it in Excel. So you create T accounts like this. Make sure to label them A through N, and then also create a trial balance like this with all of your final balances, and then make sure that they agree. So that's what I love about accounting, is that you know you're right when you balance. So when your debits equal your credits, you know that you've got the right answer because those numbers are the same. Okay, so let me know if you have any questions, and good luck on your homework.